Hello traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for October 15th, 2023, although I'm filming on the 14th on Saturday morning. It is the way it is. Anyway, hey, I just want to say there's a lot happening this week. There's a lot that happened this last week. Obviously, after I filmed the previous week ahead video on Saturday morning, last Saturday morning, there was, attacks in Israel. And since then, a lot of attacks in the Gaza Strip. Hamas and Israel are really going at it. It's a developing story, and obviously it's created a lot of volatility and uncertainty. And it's unfortunate, and I have to say this because it's so true. It's unfortunate we have to discuss this, but as market participants, it's very important because of how it's influencing the market in general. I mean, everything from, gold, you can see the nervousness in the VIX, crude, bond markets, even the Mexican peso. You're seeing that nervousness in the markets. So it does impact what we do, as unfortunate as this situation is. And it's quickly evolving. I think, if I'm not mistaken, leaflets have been dropped in Gaza. We've seen civilians, they're all fleeing northern Gaza. So, and then there's attacks on, out of the south. It's really a headline driven market. So just keep an eye on the news. And when you're not comfortable in the markets because of what may happen, you can always reduce your position size or just stay out of the markets until you see some clarity, because it is a fog of war, if you will, for lack of better terms. And so just keep that in mind. A couple other things I want to talk about before we get started. If you are not up to date with our new weekly annual offer, we only offer a discount on Forex Analytics only a couple of times a year. It's buy 1 month, get 1 month free. Semi-annual, we give a 30% discount if you go with an annual subscription, because a lot of people are very familiar with what we do, and you want to be part of our community and get the mobile app and be in our chat rooms. Take a 40% discount, and these offers don't exist other than a couple of times a year. And you all, if you've been listening to these week ahead videos for the last 8 years or so, you understand that we just don't discount our products that often. So take advantage of it. It's good until the 20th of October. Speaking of the 20th of October, I'm happy to announce that we are going to be adding a new team member to the Forex Analytics crew. So make sure that you're logged in and listening to the Face Show. Let me just show you where you can find that. You can find the link down below if you're watching this on YouTube. But if you go to the Face Show right here, you can actually register. It's free, and you can log in that way. We will be announcing our new team member on Friday. After we're done with analysis, we'll bring in our new team member to speak to you as well and talk a little bit about their background. So make sure you're tuned in for that. Okay, a couple other things I need to talk before I even get into the charts. I wanted to say that a couple of the key highlights this week are going to be, we got U.S. retail sales. We got to see how the consumers is taking in, this kind of steady, if not rising inflation. Also, you usually end up watching retail sales at the end of the year, more importantly, probably around the December, January timeframe for most economies due to the holidays. But because of the current environment we happen to be in, we're really focused on retail sales to see if this inflation is really biting on the consumer. Fed Chair, he's going to be speaking, Powell, he's going to be speaking on Thursday at the Economic Club. We'll talk a little bit more about that. But also Hawker, Waller, they're going to be speaking throughout the course of the week. And there's been, it seems like a louder growing chorus about the rate hike cycle being done, but we need to hear more indication from the horse's mouth. So on Thursday, it's going to be really important what Powell has to say. Also midweek this week, we get a lot of important data out of China. So without further ado, let's jump in the charts. Now you can obviously follow along on Forex Analytics. You can follow along on just our analysis that we post here, throughout the course of the weekend as we're updating the charts. Or I'm going to just do this with us on how we draw things over here. Okay, so let's start off with on Monday. Now I'm going to skip the euro. I'm going to come back to it here in a second, but I want to talk about the Kiwi. So we have Monday, it's actually Tuesday morning, we have New Zealand CPI data coming out. Now, New Zealand is not the only country that's releasing CPI this week. Matter of fact, we're going to have CPI from a lot of different countries. We have CPI coming from the UK, Canada. So New Zealand's number one, okay, or first up rather. Now, the market does not expect further rate hikes in this cycle, and really what could possibly alter that would be what happens out of New Zealand CPI. Let me get rid of this, and I'm just kind of redrawing a little bit just since we specifically leave this for this show. What we're going to be paying attention to is obviously the New Zealand inflation data that comes out. Again, it's Tuesday morning in New Zealand. It's Monday late afternoon for just after the New York close. But look at how vulnerable the Kiwi looks at this point. And it's not just what's happening with New Zealand and what's happening with their monetary policy. It's obviously the risk factors that are associated with having commodity type of currencies in this environment when you're seeing a potentially what could be a much bigger war involving several different countries. U.S. could possibly be included as well. You're seeing risk currencies like the Kiwi really come under pressure. So notice the really big support we're at. It's a 618 Fibonacci ratio retracement. It comes in around 59 cents. We really closed below it. Now, I wouldn't get too excited that we've closed below it, because if you look at the daily chart, we've spent a lot of time closing below that level in the past. But support and resistance is not an exact science, and it is a very, very important way to look at zones. And this area or this zone is very important for the Kiwi. So what New Zealand traders don't want to see that are long the Kiwi, they don't want to see a sustained break below those lows. In other words, a new trend low, that's not good. That's bearish. But a new trend low and holding below that trend low would be very bearish. So watch New Zealand CPI on Tuesday morning in New Zealand, but Monday afternoon here in North America. A close below 58.60 is going to be a very, very bearish event for the Kiwi dollar. So keep that one in mind, because we have a bear flag pattern, as I've obviously been drawing for you. Long consolidation, and when you consolidate at lower levels, the chances are a resumption of trend to the downside is quite high. All right, continuing on. On Tuesday, we have UK employment claimant count change, and that's going to be coming out, and we got to be watching the sterling. I mean, the sterling can't get above this descending trend line. You can see it here. We've had this obviously drawn. More importantly, I think I need to highlight here, which we talk about throughout the course of the week if you listen to the Face show. But on the week ahead video, just remember, on the week ahead video, you're just hearing my views really once a week. The Face show, that's free. You can hear mine and the rest of the team's views throughout the course of the week, and we'll highlight certain levels that we're looking at, technical levels, and obviously the macro backdrop as it changes. This is obviously very important as we're dealing with more of a headline driven market at this point. But you can catch us every morning on the Face show and also on the Flow show in European hours. So make sure you register for that one too. I happen to be sleeping, but our European team is there covering markets live for you for free. So make sure you check it out. Okay, back to the sterling. Now, we held the 38% retracement. You can see that bounce. Now, here's the problem with Fibonacci ratios. Not the problem, it's just something you should be aware of. It's a problem if you're bullish. when you have a move in one direction, like a directional move, like you see here in the sterling, and the bounce is only limited to a 38% retracement, the risks are pronounced now to the downside. Are we guaranteed to go down? No, but the risks are now tilted much higher for a resumption of trend when we can only hit a 38% retracement. It's a good rule of thumb when you're dealing with technical analysis and Fibonacci. So you can see 38% retracement, then it's complemented by a trend line. Just a really big rejection. Now, obviously, trend line or a channel. I should say, I just said all this stuff. Remember, it is Saturday morning for me, guys, so just bear with me. Trend lows here at 2050, 12050 is going to be really critical for the bulls. The bulls don't want to see that give up, because if that gives up, next thing you know, you are trading down at this horizontal support around the 118 level. So I think it looks like more like an elevator shaft right here. Down if we start breaking through those lows. So just keep that in mind. A lot of people have been fading the dollar. A lot of people think the dollar doesn't have it in it. But in situations like this, when the market is a little bit more risk averse, that's when people drop everything else and say, I think I'm going to buy some dollars here. And so just keep that in mind. Now, what else is happening on Tuesday? We have Canadian CPI. Now, we talked about Canada, about finding a dip to buy in the dollar Canadian. Well, we got it to the 50 DMA. This was last week, guys. If you remember last week, go watch the week ahead video. But look at the rejection at channel resistance, right? Now, notice the 50 DMA is holding. Bounces or pullbacks have been shallow. Channel resistance holding. Let's get rid of this. Now, what's really important here is, I think one of the things that we really need to be thinking about when dealing with the Canadian dollar is not just influenced by what's happening with the dollar. It's obviously what's happening with crude oil, the nervousness in crude, because of what's happening in Gaza is keeping a bid in crude oil from a nervous point of view, which means the Canadian dollar is going to reflect that to a certain extent. So one of the reasons why the dollar Canadian hasn't rallied substantially, in my opinion, is because crude oil is very sticky at this, 90 to 100 level, right? Or 80 to 100 level. So just keep that in mind. We'll look at crude oil in a bit, but I want you to just to realize why the dollar Canadian seems kind of trapped here. But you can see where it really opens up. My opinion is it opens up above 138 or below the 50 DMA. So in other words, we start getting below 135.50, then it becomes bearish. So inflation is going to matter, because more than likely inflation is going to push the dollar Canadian to the upper end or lower end of this range. One of the other things to think about, regarding Canada, we got to be looking at the slowdown in inflation, but the market is expecting another hike on the 25th of October. So that could put a potential hike in question if inflation comes in lower than expectations. Now, we're going to move forward a little bit, and we're going to go to the dollar, and we're going to talk about U.S. retail sales. You've probably heard me say this 1,000 times, those of you that have been listening to me for a while, it's really tough to bet against the American consumer. But the flip side to that is the American consumer, when they're tapped out, and so you can listen to a lot of different economists at how balance sheets in American households are really dwindling. Credit cards are they're maxed out. You'll hear all these different stories, but I think for the markets and for the dollar, we really have to see it to believe it, especially when you're talking about retail sales. So notice that the US dollar, and I'm going to pull up a different chart really quick. I'm going to redraw. I'm going to keep those drawings, but I want to show you this really fast, and then I'm going to remove it. There are a lot of people that are looking at this, that there's a possible head and shoulder pattern setting up with, the dollar index, right? So this would be the, arm. There's a left shoulder, right shoulder developing, right? So a lot of people are looking at the possible head and shoulder pattern with the dollar index. Technically, that makes sense. But from a macro point of view, it doesn't make sense because of what's happening with all the unless you guys think that what's happening in the Middle East is just going to go away. And if you truly believe that, oh, maybe you got a shot. Or if you think that bond yields, the yield US dollar correlation is going to stick, oh, maybe you got a shot. But I wouldn't necessarily bet on that because, when you go on a risk aversion mode in the markets, dollar gets bought, gold gets bought, bonds get bought. Wait, bonds go up, yields go down, dollar goes up. How does that work? It normally doesn't. But when crap hits the fan in the markets, things happen that you don't expect, that don't normally happen. That's when correlations will break. So, people will look at the dollar as being a safe haven currency. So when you look at this as a setup, I see that it's a setup, but remember, it's just a setup. That means the neckline is very important if we should even get back down there again. So I just wanted to point that out as you're looking at the dollar. Anyway, retail sales, focus on the core retail sales, minus food and energy. See what that number is doing. That's going to be really important. Let me get rid of this head and shoulder pattern just because it's kind of messy. Tuesday night or Wednesday morning, if you want to think about it, we have Chinese industrial production, GDP, retail, and let me make sure that you guys see my face here. Retail and residential property sales numbers are coming out on Wednesday morning in China, Tuesday night, Wednesday morning in Asian trade, Tuesday night if you're here in North America. Those are going to be fairly important. And I'm not so much focused on the US dollar CNH. I don't know where my US dollar CNH went. I'm not so much focused on that. I just care about. You can use the Aussie dollar as a proxy if you want, but I'm not really so focused on this because we're just kind of stuck. You can see we have this like head and shoulder pattern setup, but really, for those of you that trade it, and I don't trade it, I look at it more for risk appetite, risk aversion point of view, because if you start to see the CNH weaken and you start to see, in this case, the pattern would be broken. Let me just get rid of that. I don't think we need that right now. It's a little elongated. Right. But if you start to see that happen, you start to see that US dollar rally against the CNH. Remember, this is a PBOC manipulated, currency, if you will. And as a result, if you see the dollar or the CNH weakening and the dollar starting to move higher, that is a signal that the market is a little nervous from a risk aversion standpoint. And a lot of people are thinking there's no way they're going to let this thing move. You know what? Again, if crap hits the fan, China's going to engineer a weaker currency to boost their exports to help soften any type of negative economic blow it's going to have. So just keep that in mind. All right. So US dollar CNH, I'm not really watching it, like trading it, because I don't trade it, but I know a lot of traders do. So just keep an eye. We got a nice little consolidation going on. All right, moving along. Wednesday, we have UK CPI. I've already gone over the sterling. I don't need to do it again. But remember, the market, it really thinks, or is in, generally in a consensus that the UK or the Bank of England, is going to keep rates unchanged. But if we see CPI inflation out of the UK continue to be sticky, that might keep the market on its toes and thinking that the Bank of England might raise rates once again. All right, now we do have later on during the day, we actually have the FOMC Waller and Harker speaking on Wednesday, but later on the day or Thursday morning, we have let me just delete this really quick. We have the Aussie employment, which is Thursday morning in Australia. A very similar look that the Kiwi has, right? It's very choppy, as you can obviously see. very, very choppy. I haven't had much exposure in the Aussie other than buying the Euro Aussie. But as far as the Aussie US dollar goes, I just have not felt super comfortable trading it. But you can see we're just following this like descending channel. So is it a buy here? I don't know. It makes me nervous trying to buy it because you can see copper is right on its, threatening really critical support. And I guess that's one of the reasons why the Aussie hasn't really broken down. You haven't seen a real breakdown in the Dr. Copper yet. But Aussie employment will be Thursday morning, Wednesday evening for those of us in North America. So just keep that on your radar. On Thursday, we have unemployment claims, Philly Fed, existing home sales. And last week we talked about the euro, if it could get back above previous support, right? That means its current resistance, it would break out. Guess what? We went right to it and reversed. I don't know about you guys, but I shorted a lot of euro up at those levels. So, I've been playing euro on both sides this last week, but you can clearly see that the downside is still in focus. And I think now more than ever, you just look at that green line and that green horizontal line that comes in at 106.30, and just use that right now as your bull bear line. That means while we're below that 106.30, you should probably be focusing it more on the short side. If we can get above that, then you can start talking about, buying dips and getting long. So I think if you just look at that as being the bull bear line, that 106.30 level, that's going to be really important moving forward. Again, we have employment data coming out on Thursday, the unemployment claims, Philly Fed, existing home sales. The housing market here in the U.S. is kind of at a gridlock for now until employment starts to weaken. Once employment weakens, then you'll start to see, employment. You'll start to see movement in the housing market as people will be forced to sell their homes. One of the other things I want to point out really quick is I think we need to be watching weekly unemployment claims very closely. It looks like we are getting towards that time where you might start to see those unemployment claims really start to rise, and so just think about that as we move along, over the course of the next couple of weeks. All right, now on Thursday, the most important thing is that we do have the Fed chair speaking at the Economic Club luncheon. And he's going to be talking, and making comments about monetary policy. This is super important, and I'm going to take you over to yields really quick, and I want to talk a little bit about the bond market and what you're seeing in yields. So, first and foremost, let's get over to the 10-year, and you can see the inverted head and shoulder pattern that is developing. So that means that yields really need to start coming down. Bonds need to rally in order to reverse this very bearish trend you've seen in the bond market. Now, can that happen following the Fed chair? Well, based on what the chorus that you're seeing being sung by so many Fed members over the course of the last week, it seems like the Fed might just end up keeping rates unchanged for a while. And then if you take into account the recent events that just started last weekend, going on obviously today in the horrific events in Israel and Gaza, the Fed might just say, due to these risks, we should keep rates unchanged. So it's going to be really important to watch the Fed chair's tone, because we've already seen Fed governors talking this way over the last week. So if the Fed chair echoes that going into Thursday, we could see not only the dollar weaken, but we could see yields at least start to come off, and you can see bonds might, continue to get a bid here. So we'll be watching the bond market, especially if the 10-year gets above this neckline, or, you can just call it about 108.15 or so, roughly, right around there. Bond market unleashes a move higher. Yields will come down. Now, whether the dollar responds to yields going down, again, think about what I said earlier. Depends why bonds are going down. Yields are going down. If yields are going down because it's risk aversion, the dollar may not be responsive in that situation. If bonds are rallying and yields are coming down because of what the Fed chairman had to say on Thursday, the dollar would be responsive. Again, why bonds are moving is going to be the reason why the dollar moves or not, right? That's one thing that the dog is wagging the tail, not the tail wagging the dog. So think about that, and I'll stop here. And I'll say this. Guys, gals, if you think that these videos are valuable to you, I've got more to talk about. If you think they're valuable to you, you think, this preparation work is great, do me a favor. I don't ask for many favors from you. These are free videos. Thumbs up. If I miss something, comment down below. And if you see us on social media, you see a tweet that comes from Forex Analytics or myself about the week ahead video, retweet it. If you see us on LinkedIn, share it. If you see us on Facebook, I don't even know if we're on Facebook, but if we are and you see it there, give it a heart or a thumb or whatever they do on Facebook. I'd appreciate that type of support. Like I said, this is my Saturday morning too. So if you can help us out, that'd be great. I'd appreciate that. Okay, continuing on. Let's go over to Friday morning. We have UK retail sales very early. Obviously, for me, I'll be sleeping. But again, we've already talked about what's happening in the sterling. I think it's important that you just realize the 38% retracement continues to hold. We have Canadian retail sales. We already talked about the dollar CAD because of what's happening with CPI earlier in the week. So we'll be watching these ranges. We'll see actually if this long-term channel can be broken to the upside, especially if we have some weaker CPI, weaker Canadian retail sales due to the fires or whatever the case may be. Watch that. Now, we also have on Friday Mexican retail sales. Now, I want to talk about the dollar mex and I'm going to go back to what I said earlier on this at the very beginning as I was making an intro with you guys about the nervousness of the market. You can see the dollar Mexican peso clearly holding the 200 DMA. You see how we're just, let me grab the pen. See how we're clearly holding that 200 DMA? Because we're clearly holding that 200 DMA, my 2 cents will be, as long as we hold above that 200 DMA, that means that the market is it's poised for more risk off, or at least nervous enough to be buying dollar Mexican pesos, despite fighting the carry that is associated with shorting Mexican pesos. That means the market says, shit, I'll pay the carry. I don't care. It's better than, getting my face punched, owning stocks, if the stock market comes down. So just think about that, when the market starts positioning itself certain ways. So we do have Mexican retail sales on Friday. Obviously that's going to be pretty important. I want to actually keep that. I'm going to change that. It's a little bit darker green. There we go. Continuing on, since I was discussing the Mexican peso and how important that support is at 1780, 1778, let's just take a look at the VIX. We already showed you the bond market, but let's take a look at the VIX. You can see the VIX is starting to firm up. We're getting close to resistance, which that should be a pretty good indication that if we break above 21, volatility is going to be breaking out. That means the market is pretty much freaked out about what's happening. Now, I haven't talked about gold, but I should. Let's discuss gold. Gold has rallied substantially. We talked about it last week. If we can get above this 1860 level, it'd be bullish. Well, I didn't expect, nor did anybody else, that what happened in Israel and what's happening in Gaza right now would have happened. And you can see gold is really responding. We closed at or slightly above the 200 DMA. So again, you're seeing this, response in risk aversion that is really manifesting in the Mexican peso, VIX, the bond market. You can see bonds catching a bid. Gold. I mean, look at gold. We are above the 38% retracement now. So what that says to me is that the gold market probably has further to go. Yeah, the 50% retracement comes up at basically 1950. We know that this 1950 level is horizontal resistance. I think, if I'm not mistaken, You can go over here to the bias chart, which we put together on the morning edge every day. And you can look at that. We had 1950 written on Friday. Those are the key resistance levels, 1920 and 1950. You know, we closed above 1920, which was basically the 38% retracement, and the 50% retracement is, you know, right here. We get above 1950, and next thing you know, we're trading up at this 618 retracement. So you think about how far the gold has gone, but how impulsive this move is. It really has the ability to continue even higher. And it's going to force the market to be chasing, not only getting squeezed, but also chasing for those people that wanted to get long and said, oh man, I was waiting for 1770 and, you know, here's gold. And then, you know, at some point the market will say, screw it, I just need to buy gold. And that's usually going to be the top. But I still think there's some distance to go here in crude or in gold. Now, speaking of crude, let's talk about that really fast before I move along into some indices. All right. Here is the crude oil market. There we go. Now, crude's done a pretty amazing job of screwing pretty much everybody. If you remember, a couple weeks ago, we were talking about that false breakout. We got close enough to completing that flag pattern, the pennant right here. And once we completed that, it's like, don't get long. Everybody's long, basically. Everybody's bullish. You don't want to be long up here. It's a false breakout, and it slipped. And then we broke below the 38% retracement like that. You can see how we broke below the 38% retracement. And because we broke below that 38% retracement, how many people actually turned around and got bearish or actually sold their longs? And then, obviously, all the events happened last week. We gap higher, and notice how we have just basically filled that gap. And let me remove these green squigglies here. So we filled the gap, and we're going higher. We're back at 88. And look, crude oil is a market that is really being affected by what's happening in the Middle East. Between, you know, production cuts and then, you know, the tensions that are rising in the Middle East, and you know, different ports might start getting closed, different supply lines. Crude oil could be trading north of $100 pretty quick if it wants to be, and if things continue to escalate. So I think crude is a good measure of how the market is feeling about the tensions in the Middle East. The higher it goes, it probably feels that the tensions are increasing, and vice versa. Okay. Now we're going to actually, you know what? I want to stop one last thing, you know, while we're here. You know, we're seeing a lot of volatility in the market. If you want to learn how to take advantage of this volatility, and you want to learn, you know, it's volatile, so you don't want to risk your own money, you don't have to. You have other choices. Check out the trader funding program. You can get to the link just below. Right? If you want to learn how to access larger trading accounts, like a $25,000 account, which would be our minimum, or you want to learn how to trade a $250,000 account or $1 million account, you have to take an assessment, and to simplify it, there's a lot. There's I don't want to say there's a lot of rules. There's a few simple rules. One of them is basically you got to make 10%, and you can't risk more than 6% on a trailing basis. So that means by your high watermark, you can't lose more than 6% of your high watermark. If you can do that in an unlimited amount of time, you can actually qualify to trade a larger account. So check it out. Why not? Why not be able to take advantage of this volatility with somebody else's capital and not risk your own capital and with a larger amount of capital? There's a lot of volatility happening right now, and one of the best ways to take advantage of it is the trader funding program. So check it out. Okay, I just wanted to mention that really fast. Let us go back to the markets, and I want to talk about what's happening in the S&P. And what's happening in other markets as well. So, yeah, you got the S&P. Big rejection here. Let's go over to the daily chart. Big rejection of 4,000. We're back at 43.30. We're slightly below it. Obviously, we closed below it, but 43.30 has been a big pivot. You know, so we may be below it, but this is all an area, right? Obviously, key support right now is going to come in down here around 4,200. We're at 43.30. I think you need to be watching that because, it's the obviously channel support, 200-day moving average. And while we're below 4,400 or the 50 DMA, you have to be a little bit more on guard, right? So let me just make it real simple for you. You see the 200-day moving average? It's right here. You see the 50 DMA? It's right here. Do you see the box that I'm drawing for you? That's your playground. So imagine you're just this little kid and your parents say, all right, little Sarah or little Johnny or little whoever your name is, stay in the sandbox, play in the sandbox. That's your sandbox. You get above the 50 DMA, market's going to get bullish. Why? Maybe we've gotten peace. Thank goodness. Maybe the Fed cut rates. They're not going to do that right now, but maybe they do. Who knows? You get above the 50 DMA, S&P looks pretty constructive to the upside. You get below that 200 DMA, and you have to imagine up on an escalator, down on an elevator. That means we probably are going to continue to follow that elevator shaft lower. So that's your sandbox. 50 DMA, 200 DMA. Okay? Make it real simple for you guys. All right, let's continue on. NASDAQ 100. NASDAQ 100, this could still be a head and shoulder pattern, believe it or not. But I want to delete that, and I want to show you that we actually have a descending. I talked about this on the trade-off this week with Chris Weston. We have a descending channel, right? We have a descending channel. You guys might be able to look at it as a flag pattern, but I'll tell you what, while we're below that high, I would just be expecting a move back down to 14,200 by the time we get there. So just, the NASDAQ 100 looks vulnerable. I guess that's the point I'm trying to make. You can look at the Dow, you can look at the Russell, but I'm going to take a look at the DAX. Big rejection at the 200-day moving average. What does that tell you? While we're below the 200-day moving average, you have to be very careful with being long German stocks. Also, do you guys notice what else is happening on the DAX? Just eyeball it. Tell me what you see. The 50 DMA is starting to touch the 200 DMA. I know death crosses can be a little silly, but there are some validity to them. Just because we get a death cross doesn't mean you should ignore it. Sometimes when they cross over like that, you actually see, pretty big moves. So just don't ignore it. I don't necessarily say you should trade on it, but don't ignore it. One last thing I want to cover. I know we talked about this over the last couple of weeks. Let's talk about the Nikkei. Where in the hell is my Nikkei? Did I just skip over it? There it is. It's right above where I'm at. Okay, so the Nikkei. Really 31,000. It's continued to be really critical support. We made a false breakdown down below. We bounced. But is this bounce about over? Well, you tell me. We're at the 618 Fibonacci retracement. I know a lot of you guys trade CFDs on the Nikkei because you're not in the United States. You're in Europe or in Asia or in Australia, wherever you're at. When you look at something like this in the Nikkei and you're like, well, if every other market comes under pressure, wouldn't Japan too eventually? Sure. I just think Japan is going to definitely come under pressure if everything else is coming under pressure, like the U.S. equity markets, the FTSE, the DAX, whatever markets you're looking at. The Nikkei is probably going to buckle too, but the Nikkei will probably end up outperforming U.S. equities, but still doesn't make it immune, doesn't make Japan vulnerable and immune to downside. So if you're going to risk above those highs to make back down here where I have that circle is, you can see, and let's just do the math for you. If you guys want to do the math really quick, let's say you entered right here at the 50 DMA 32,275, right? 32,275, and your stop loss is let's say 32,753. And your target is back at, we'll just do it 31,000, right? You still have a risk reward ratio of 1 to 2.6. You know, if you look at our close patterns in play over the course of the last 8 years, as a company and as a team, this is not my specific results. It's not Greg Horvat. It's a combination of all of our team members. You can see them right here, right? Over the last 8 years, you can see the total winning trades of patterns in play are 52%. Total losing trades, 48%. But the total return is 288%. You can go through and historically go through all 82 pages of these if you want to. But I don't care about the results so much. Well, I do. I care about the percentage, right? If you're right 52% of the time, and you have a risk reward ratio of 1 to 2.67, that's how you get ahead in trading. You know you're going to be wrong half the time, maybe more, maybe less. But if you have a good risk reward ratio, that's how you end up coming out ahead over time. And I hope with that, you got something to take home with you. So guys, gals, Monday morning on the Face Show, I'll see you there. Don't forget, on the 20th of October, we're going to be announcing our new team member and introducing that person to you on the 20th. And don't remember, our pricing goes away. Our cheap, inexpensive, discounted pricing goes away on the 20th. So take advantage of that right now. All right. Thank you for being here. I will see you on Monday morning on the Face Show. And I appreciate you spending your time with me, because I know that your weekend time is very valuable to you. So give yourself a thumbs up, or me one. Have a great one. I'll see you soon. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.